I am Jon Rotonti, and this is My Investing Life, where I interview the investors I admire most to learn about their investment process and philosophy. And as I just said, there is no investing firm that I admire more than NZS Capital, other than the Motley Fool. Many of you are familiar with Brinton Johns because he was my very first guest on my very first episode of My Investing Life. Brinton is the co-founder of NZS Capital. Prior to that, he was the leader of the global technology sector team and the co-portfolio manager of the global technology and innovation strategy at Janus Henderson. Jon Bathgate is an investor at NZS Capital, and prior to that, he was the co-head of the technology sector team at Janus Henderson. In 2020, NZS Capital's two global growth funds generated returns net of fees of around 63 and 65% respectively. So today it is my pleasure and my honor to welcome Brinton and Jon to the show. How are y'all doing?
Good. We're doing great. Thanks, Jon.
We're good, Jon. Thanks for having us, and we're flattered to be part of this. It's a very cool series you're doing, so we're flattered to be part of it.
Thank you so much. Brinton, it looks like you're coming to us from your treehouse. Is that right?
Yeah, I'm coming to you live from the NZS treehouse. One of the fun things about COVID, there's not many of them, but one of them was my daughter and I binge watched Treehouse Masters, which led her to say, "Hey, Dad, can we build a treehouse like that?" And I said, "No, but we could try." So we spent last summer building this treehouse together, which was a ton of fun. A lot of YouTube videos, and then it's also just a quiet place to do Zoom calls when you got 4 kids in the house doing remote school.
That is fantastic. This is my 18th episode of My Investing Life, and first one where I have a guest in a treehouse. And
all right, so we're excited.
Yeah, I'm loving this already. So Brinton, while I'm speaking with you, can you remind us what is NZS Capital's investing philosophy, and what types of businesses do you like to buy stock in?
Yeah, so for some of you may have tuned in last time, but you might remember we're a little bit different. We look at the world a little bit differently. Actually, I've got a slide if that's helpful.
Yes, please.
Jon, let me see if I can do this successfully. Tell me if you. Yeah, let's see. Okay.
Yes, I can see that.
Okay, there should be. You see bees and ants here?
We see bees and ants.
All right. So we actually take more cues from biology than traditional financial theory. We understand traditional financial theory. We've done a lot of work on it. But what we see in the world is it doesn't really conform to sort of the economics most of us were taught in school. It really conforms more to these things called complex adaptive systems. And complex adaptive systems are sort of the systems that rule all of life. And so it's sort of no surprise that they also govern what happens in the financial markets as well. And so the big takeaways for us are that predicting is really mostly a waste of time. No one can predict the future. So instead of trying to predict the future, what do? Well, you focus on companies and systems that are adaptable to a wide range of futures because you just don't know what you're going to get. So the picture of comb, these are my bees. I'm a beekeeper too, as some of you might remember. And then the ants, like the ants needed to get across these plants, so they just built a bridge. You couldn't have predicted how they would do it, but they're so adaptable. And then instead of, finding these sort of fleeting states of equilibrium, like economics math would have us try to do, we just think the world is constantly in a state of disequilibrium, and it's actually dynamic. And so the types of companies we're looking for are actually, can you see that I just updated my slide? Did that come through? Okay,
yes,
cool.
Yes, we can see that.
We look for these companies that we consider resilient or optional. And really, we're trying not to do anything in between. We have a couple examples here. Resilient stock, which we can go into later, would be a stock like Amphenol. And then a more optional stock, a stock like Tesla. And the way we do this, our process is always exactly the same. We focus on quality, growth, and context. We can go into those later if you like. But really, we're looking for these high quality businesses where the downside risk is very low, to put in the top half of our portfolio. We concentrate those names, so that's about 15 names. And then we're looking for these really asymmetric or optional businesses for the bottom half of the portfolio. That's about 40 names, and we distribute the risk there. And then in the middle, which for us is anything between a 1.5% and a 2.5% position, we own nothing.
I love that. I love the simplification. We own nothing in the middle. So since the future is unpredictable, you want to invest in businesses that can adapt to multiple different futures, whatever the future will look like. John, so Brinton touched on it briefly, but can you discuss NZS Capital's portfolio management strategy? How many stocks do you typically own? How many of those are resilient? How many of those are optional? And what's the percentage of resilient versus optional in the portfolio?
Sure. Yeah, so we actually run 3 portfolios at NZS. So, excuse me, the first one is our global growth portfolio, and that's about 50 to 60 names. We also have a tech product that's more of a TMT product. That's about 50 names. And then we have our concentrated global select product that's about 20 names. So just, I guess, to use global growth as an example, out of the 60 names, we'll usually run 15 to 20 as resilient. And that bucket of the portfolio actually be very low turnover. That's like 10 to 15% turnover. These are stocks we honestly want to own forever, but at least like on a 10-year time horizon. And then the resilient or the optional part of the portfolio, that's more the 30 to 40 names there, that'd be much higher turnover, like still 30 to 50% range. And then to Britton's point, we honestly, at any like snapshot of the portfolio, we own very little in the middle. And so that's kind of the way we construct it. And we have to kind of flex that with different portfolio constructs. But the overall portfolio construction strategy is pretty consistent across all 3 strategies.
That's wonderful, and there's a beautiful slide representing what John just said. So Brinton, sticking with portfolio management for a second, because it is something that I think that y'all do so uniquely and so well, quite frankly. If you're buying an optional position for the first time, what is a typical size of a starter position? And then how do you deal with an optional position that has a massive jump in value? So you used Tesla just now in one of those slides as an example of an optional position. I'm pretty sure NZS had owned Tesla shares throughout 2020, a year in which Tesla stock almost 8x. It was up almost 8x. So how do you deal with that when an optional position increases in value 8x in 1 year?
Yeah, so just to go back to the slide that John just hit on, this is really like a snapshot of our portfolio. The tail is long, the head is more concentrated. Really, we're thinking about not losing in the head of the portfolio. What we find with a lot of companies, and what honestly we've done ourselves in the past, is people tend to get this reversed. It's like, so you want the base of the triangle to be very resilient, and the tail or the tip of the triangle to be optional. But a lot of times, what people do is they actually stand that on its head, and then it keeps falling over. Right? It's a fragile way to build a portfolio. So the way that we build it, we think is very anti-fragile. A stock that we're very comfortable with these small positions. So like over here in the tail, we might own a 15, 20 basis point position. And the pushback that we get sometimes is, why would you waste the brain cycles on a 15 bip position? And the reason we do it is because we actually think the company is quite asymmetric. But maybe we're new to it. We just don't know it that well yet, or maybe the valuation it's not a fat pitch yet because it's so crazy. We see a lot of that in this market that we're in now. And we know that if we own it at 15 bips and it gets cut in half, it doesn't hurt us. But we know that if it's in the portfolio, we're just much more likely to solve for that bias of, I don't want to buy it, it's down 50%, when it's down 50% and it's a name that you've liked for a long time, that's when you should probably be buying it, as long as there's not fraud or something. So when it's in the portfolio, that bias is gone. We're just able to immediately add to it. So that's why we own these small positions. We find it very helpful for us, sort of a mental shortcut to trip that human bias. A name like Tesla, which we did own all last year, we still own. what we find oftentimes is when these optionality names express themselves, one of two things can happen. One is the business is actually becoming more resilient, and we want to add capital to it and bring it through the middle of the portfolio and actually bring it to the head of the portfolio. The other is the valuation is just going much higher because people have more hope about the future of that company. And a company like Tesla is hard because in fact, they were selling a lot more cars last year, and the predictions around Tesla becoming a winner, perhaps the winner in the EV market, got narrower, meaning, they are more likely to become at least, probably the top EV maker, if not winner take most. And the valuation also went crazy to sort of these stratospheric levels. And so what we did throughout the year was actually Tesla never got above a 1.5% position. It never went through the middle. At times we were trimming it every week, sometimes daily, just to keep it out of that middle. And we harvested a lot of alpha from Tesla last year. So people have two responses to us typically. One is, well, how can you own a name like that? It's so expensive. That's crazy. And the other is, well, you left a lot of money on the table. And so both, yes, correct on both accounts. But also, we never allowed a company like that, just using Tesla as the example, to become 50% of the risk of the fund, a stock that can literally torpedo the portfolio. So we felt like the risk level was actually in line with the position, with the name and the position size the whole year long.
And I'll just add, just to jump in. Sorry to cut you off, John, but
please.
The reason that we've kind of come up with our portfolio construction process the way we have is we've kind of lived this and done this together for more than a decade, and we have in the past owned optional positions in the head of the portfolio and kind of gone through the pain when they do. The range of outcomes widens maybe more than you expected, and all of a sudden you're sitting on a stock that was in the head of the portfolio and it's down 40 or 50%, and you also feel hamstrung because you didn't really want to add to it yet because it's kind of the stuck in the middle position. And so I think we've kind of learned this lesson the hard way, and that's why we keep names out of the head of the portfolio. And like Brinton said, it's kind of not for everyone, but the process has kind of worked for us.
Absolutely. Yeah. If you do that twice a year, you torpedo all of your alpha.
Yeah, totally. And for those visual learners out there, I love flipping that triangle on its head, right? So you want the resilient base to be your resilient positions, but if you put an optional position and you flip it as the point, it becomes very fragile.
It becomes very fragile. And what happens is people who do that right, especially 2 or 3 times in a row, it's just lucky. They hit a couple of options in a row. It's like going to Vegas and hitting 22 black 3 times in a row. But in investing, when you're right 3 times in a row, it never gets explained as luck. You write books about it and you explain it as skill because that's what humans do. But really, it's just luck. And so you have to be really careful, and that's why we surround ourselves with a team. Because when I'm, full of it, John will say, "Hey, Brinton, you're full of it," and I know that John's not trying to get me or trying to be, cute or whatever. He's just trying to help us all win in the portfolio, and that's what's so helpful to us about also the team process.
Awesome. So, sticking with this same line because I'm fascinated, John. Under what circumstances does NZS Capital allow an optional position to grow into a much larger resilient position?
Yeah, Brinton kind of hit on this. I mean, I think that the first thing is it's always a deliberate decision. Like we'll never just kind of like start with a position that's 150 bips and then just let it grow its way into the head. I think to Britton's point on Tesla or other stocks that have been kind of successful optionality stocks, we won't just let it cross over. So the first thing we'll honestly do is just have a team meeting, and usually someone close to the stock or even someone not close to the stock will raise their hand and say, why isn't this a resilient position at this point? And so we'll go through the thesis on the stock, and generally, I mean, Brinton kind of described this, but usually if we're going to move something from optional to resilient, there's usually a structural change in the range of outcomes in the business. And like most of what we're looking at in the optionality tail, honestly, is like a pretty wide range of outcomes. And like you can see them kind of narrow over time. And that could be honestly a company is just kind of, further along in its S curve and it's maturing, and we've got better visibility into what the future of the business looks like. Maybe honestly something is becoming a little more platform-like, where you feel like you can kind of see the flywheel effect building. It could be a structural change in the overall industry dynamics, like we've seen in semiconductors, which we can talk about. But it's usually something that's a structural change, and it will be a deliberate decision. I think those are kind of the two key points.
I love that, Fool. So either it's getting further along in its S curve, it's adapting into a platform, or there's some structural change going on. So, Britton, really quickly, what does it mean to squeeze out the middle of your portfolio?
Yeah, well, again, like John said, we've learned all this the hard way. We've made a lot of mistakes, and we've been doing it for a while now. And one of the mistakes that we figured out we made back in 2013, we had 8 years of data on the portfolio. We cut the portfolio by position size, and we sort of always intuitively been running the lowest downside names at the top. And the highest asymmetry names at the bottom. And we cut it above 1 to 2% positions and below 1. And over that 8 years, we found that we actually performed really well above 2% in those resilient positions. And we found that we performed really well in those 1 and below percent positions, those optionality positions. And between 1 and 2, we were actually market performing. The problem was we had a third of the portfolio between 1 and 2. And so those were names that were sort of, maybe they got really expensive and we cut it, but we didn't want to sell it all the way. And so they went between 1 and 2, or there were optionality names that worked. But really the risk hadn't gone down, they were just working. And so you feel smarter when something's working, you think it's less risky, but a lot of times it's actually more risky. And we didn't cut it proactively. And then they went back and cut themselves for us because they went down 40%.
Right.
And so, so we immediately said, okay, anything between 1 and 2 is stuck in the middle, and it's neither resilient nor optional. It has to go. And we took it up, we took it down, we took it out, and we took a lot of names out, like the next week. And then we sort of started writing about this investment philosophy, and we figured out that was the biggest drag on our alpha. And I don't think we're unique in that. I think that's probably true in a lot of portfolios.
And I'll just add, since I was one of the analysts that was told to find names to take out of the portfolio. At that point, I mean, one of the things we saw at that time, and like probably stuff that gets stuck in the middle now still, is just kind of like GARPy companies that are like good companies, but they're probably not honestly like incredible enough to belong in the resilient head of the portfolio. But we still feel compelled to own them, or maybe they have too much end market exposure in one end market or something like that. And so that is something that gets caught up a lot. Is just kind of these GARPy but not quite, at the pinnacle of resilient kind of names.
Yeah, totally. So I'll toss this one to either of you, jump ball, or you could both come at it. So I really want to drill down into the research process at NZS Capital. What does it look like? Do you have assigned companies that you follow? Do you have regularly scheduled meetings to discuss new stocks or portfolio changes? What does your team research process look like?
I'll start, and Britton can jump in. Yeah, I guess the first thing is we don't actually have assigned names. Like I think we all have kind of subsectors that we have a lot of history with, and so it's kind of honestly just known within the team because we all know each other so well. If a name reports earnings or there's important news flow, that one of us will chase that down and get it out to the team. And I mean, to be honest, it's very rare that we're actually reacting to quarterly earnings or news flow in our process, but it is obviously just being diligent. That's something that we do. But part of our process that we've kind of had in place for a long time is we usually have more than one set of eyes on a given subsector. Like Britton and I have both covered semiconductors for a long time. So we'll both be looking at that. We'll have multiples of us looking at e-commerce or payments or kind of the other themes in the portfolio. Just given, I think we don't really want one investor to be just kind of like down the rabbit hole and come out with all the insights. I think it's good for all of us to have a spirit of debate and really know each kind of subsegment really well. And so that's kind of our overall framework. And I would say just kind of our DNA in investing that we've kind of developed over the last decade plus working together is really to act like industry participants. And so we really spend most of our time reading industry blogs and going to virtual trade shows, which is actually great because all the industry events are online. But we rarely go to investor conferences. We spend some time with management because we want to know who we're involved with, but we don't put a lot of credence in what management tells us, not because they're bad people, but just because they're usually really bullish on their business kind of for their own reasons. And so I'll leave it there. And if Britton has anything you want to add maybe on quality growth and context.
Yeah, actually, I'll just share a screen really fast. So I hit on this earlier, but quality growth context is sort of the heart of what we do. We look at everything through the same lens. We start with quality, and we're really thinking about the management team. We'd like to see founder family management teams, but we definitely want to see long-term focused management teams and not sort of rent-a execs running the company. We want to see a culture of innovation and sort of a proven track record of adaptability. On the growth side, we're looking for NZS. We're looking NZS, the way to think of non-zero sum is just creating more value than you take. So we're looking for companies that are truly out to create more value than they take. And this is very anti a sort of Michael Porter competitive moat company, which I'll be cynical and sort of paraphrase Michael Porter as I'm going to build a moat around my business so I can screw you on price. So we're not looking for that. And then we don't want the growth to be too fast. We actually want there to be a negative feedback loop on the growth that extends to the duration of that growth. So companies that grow too quickly actually scare us. And then on the context, that's where we look around the world and we say, okay, what's going on? Is the world, is time on the company's side or is it against it? And then finally, we look at the valuation, not because it matters least, but because we find that if you look at valuation first, you tend to strain out a lot of really good ideas that maybe will grow into a valuation or maybe have access to bigger markets than you might imagine at the beginning. So that's really our process. Everything gets put on a one-pager. It never really ends up as one page. It's usually like, we make the margins really big and the font smaller every week, I think. Right. But like a couple pages, and then we distribute that 24 hours in advance of the meeting. It's everybody's responsibility to go through it. We don't believe in stock pitches because when you pitch something, you tend to try to get other people to believe it and, hey, come to this point of view. And we're not trying to do that. We're actually trying to eliminate bias. So everyone does the homework before the meeting, and the meeting is all about the debate. It's not about the pitch or the research.
Maybe I'll just add one quick piece that I left out is we all have the same title at NZS. We're all just investors. And so if a member of the team wants to add a name to the portfolio, especially something in the optionality part of the portfolio, and it's one of us likes it and then the other three hate it, we'll still put it in because we all trust each other. We work together for a long time. And there's no kind of figurehead at the top of the team that says I hate this, move on to the next one. And so that's a little bit of a unique way that I think we have managed things over time.
Yeah, well, just to tag on to that, sorry, this is the last tag on, I promise.
No, they don't want to hear from me. They want to hear from you guys. So please keep going.
What we've proven to ourselves, from being in the business for a long time and watching a lot of different models, is that portfolio managers tend to destroy value from analysts. That's sort of the dirty secret, I think, in the investment industry, because PMs are sort of like the pinnacle. They're the gatekeeper of the portfolio. But really, if an analyst has done the work, then nobody knows the stock better than the analyst. And if they have a strong opinion and you hate it, you might be right, but you probably just have bias against that name from some recent or previous history that the analyst doesn't have bias on. And so we find that when we lower the drawbridge and let these ideas in, anybody can get an idea in any day of the week. It's going to be a smaller position size if we don't agree. But we find that we get alpha that way, and we destroy alpha by limiting them.
Awesome. Brinton, what is something you think the market gets wrong?
Yeah, I think it's this point I was making before about growth. Investors tend to be schizophrenic, and I'll put myself in the same bucket, but it's either really skeptical or really imaginative. So and we see this a lot in the market today, where it's oh, no, this stock completely deserves to be 100 times sales or, some crazy number. Or, oh, no, that's the stupidest idea ever because that's one stock as a market cap bigger than, all the other automakers, for example, combined. And I think it's this idea of honestly having enough imagination for what can go right. And then also playing devil's advocate with yourself about being skeptical about what could go wrong. So the way we do that is we try to have a lot of imagination about what could go right. We try to have a lot of imagination. For example, I'm just going to throw this slide up because we use it a lot, of sort of the duration of the S-curve of a stock. Here we go. And so we want that time to be as long as possible on the S-curve. And then the possible other S-curves the company could tag on. So just to take Tesla as an example, obviously the duration can be very long. It's the auto market. They could also stack software S-curve onto this. With self-driving, that could be a SaaS model. They could stack an insurance S-curve onto this, because what better company to insure you than the company that has all the data on you, right? And it can go on. So there's a lot of other examples. I'm just using that one because it's the one we've been using. So it's this idea of having enough imagination, but also rooting that in numbers and actually being skeptical too. We do that through limiting position sizes. And then we say, okay, the more asymmetry, of course, we want that in the portfolio. But if it's a narrow prediction with a really broad range of outcomes, that's okay. It doesn't mean we can't own it. We just have to size the position right.
Written on that slide, you had something called root mo. Can you tell us what root mo is?
Yeah, another geeky term we use on the team. We're really terrible at marketing. This is just a term we made up. We call it resilience without of the money optionality, root mo, resilience without of the money optionality. This is a name that we find actually not very often, but when we do, it's really special, because root mo just means, I'm just going to put up this slide again if I can figure out how to do this quickly. You have this resilient base of a company. I'll just use eBay. It's an old example, but eBay, back when John Donahoe just came to run it, the marketplace businesses was struggling. Gosh, I don't even remember what year this was, John. Maybe 2008 or 9 or 10 maybe. The marketplace business was struggling, and they had this fantastic asset in PayPal. They had a new CEO come in, which we didn't know was going to be an absolute star, but we thought he was really good. But since then, he's become just a star. And we looked at the business and we said, if they could turn this marketplace business around, that's all we're paying for. We're actually getting that pretty cheap. So we get PayPal for completely free. So you had this resilient business that was actually becoming resilient again. And then you had this massive out of the money option with PayPal, and you can value that and you can discount it back to today. And so you said, okay, well, our downside is actually only 10 or 15%. It's really low, but the upside is more like a couple of 100%. So with a name like that, you can actually bring it to the head of the portfolio. And back to the triangle example, it's highly optional. It seems like it should be at the tip because it's so optional, but it's actually in the base because the downside is so low. And the sin with a name like that, when you know it, is to not weight it correctly. So you can weight that at a 6% to start with, and then you can let it go for a while, and you're not adding risk to the portfolio. So these are the things we dream about at night, we wake up thinking about, and we hope we get a few of them a year.
Awesome.
This is the holy grail, for us.
Resilient plus optionality. Fools, really quickly, John Donahoe, he went on to be CEO of ServiceNow and now Nike. So he really did turn into a star. John, same question to you. What do you think is something the markets get wrong?
Yeah, I mean, this is a big part of our framework, but I'll just say, a lot of market participants still think in terms of just like a normal bell curve. And you hear just so often about like XYZ event is a 3 standard deviation event, or like we were kind of joking about like GameStop was like a 6 standard deviation event, which happens like once in 6 million years or whatever the numbers are. But it's like these things happen all the time, and that's why we try to think more in the context of complex adaptive systems and investing in companies that are nimble and adaptable, because the tail events happen all the time, and that's honestly where a lot of the good stuff happens and a lot of the bad stuff happens. And so I think it's amazing how much of the market is still kind of focused on kind of the normal distribution, but that's the way we think about it.
Awesome. So John, you said that you and Brinton, as we all know here, cover the semiconductor industry as well as anybody that I know. What do you like about semiconductors? What are the long-term growth drivers for the semiconductor industry?
Yeah. So a few things. I think just for context, we've had about a third of the portfolio in semis since inception. But the first thing, I think this is becoming more visible like every day right now, is we just think the whole global economy is digitizing, and that pace of that is actually accelerating. And for a lot of the applications you're looking at, semis are really the building blocks for the digitization of the economy. And some parts of the economy are are obvious. Like I mentioned, like we're all on Zoom, and this is honestly being powered by x86 CPUs and NVIDIA GPUs in some cloud somewhere. Or we're all on our phone, 8 hours a day, and that's just like $360 worth of silicon with a battery and a display attached to it, basically. But then you also look at, I mean, in the news right now, obviously, is the shortages in automotive, and like all of a sudden you can't even, ship an F-150 without chips, and so honestly, a lot of the innovation in the automotive market is around active safety and eventually autonomous driving and electrification. And I mean, like the next car I buy, I care a lot more about like the infotainment system, and will it have Android Auto, and will it have like lane departure detection or collision avoidance? Will it be a hybrid? I mean, all that honestly matters a lot more to me than like how many horsepower it has. I think that's just like a great example of the way the world is changing. And so that's the first thing. I think like semis just generally are having a renaissance, and they're just pushing into every part of the economy, and anything that's kind of analog now will be digitized in the next 5 to 10 years, and semis will be kind of building blocks for that. And the other thing I think is just the business models, and semis are still kind of underappreciated by the broader market. I mean, if you look at a lot of what we own, and we kind of joke about this, but like if you ask the average investor, like who's more profitable, Texas Instruments or Microsoft? Like I think most people don't know that TI actually, even at like the trough of the a 3-year down cycle, is actually about as profitable as the biggest software company in the world. And that the cool thing about semis is this goes not just for like the biggest and best. If you go across the whole kind of value chain from the chip makers to the foundry guys like TSMC, to the equipment makers, to the software guys like a Cadence or Synopsys, like everything has gotten so hard to do just because of the needs to keep up with Moore's law, that everyone is amazingly profitable. It's like this amazing industry where the whole value stack is carved out with kind of 2 or 3 players that have just amazing business models. And so that's something we get super excited about. And so I think those are kind of the 2 key things that get us fired up about semis. And then just on kind of the future of the industry, I mean, one of the things we've been kind of talking about is like there really is no next big thing in semis that we see. Like for a long time, it's always been kind of a big like computing application or a big consumer application that drives the industry. It was like the rise of the PC or the rise of the smartphone, and watching like 3G and 4G, coming to smartphones was a big driver. But now it really is. It's like, it's the car, it's the industrial market, which is really like 13 or 14 different submarkets, from factory automation to building automation to medical devices and how drugs are delivered. I mean, the cloud and smartphones are more obvious. Gaming is honestly becoming a huge market for silicon. And so it actually builds on the resilience of the industry. Back to kind of our framework is not just one application that's driving all this. And so we don't have to worry about, how is the iPhone cycle going to be in 2021, or what's the PC cycle look like? It's just this breadth of demand that's really honestly amazing to see play out.
Wow. That was an amazing overview. So let's go into some of your...
mic. That was awesome.
Yeah, that was an amazing overview.
I think we've done that a few times by now. So
yeah, we're probably going to clip that and send it all off to our members many times. Let's dive into some of your semiconductor holdings. Brinton, what does NZS like about Taiwan Semiconductor?
Yeah, TSMC, for viewers that may not know the company, it stands for Taiwan Semiconductor. They're a foundry, which just means they make semiconductors for other people. It's arguably top 5 most strategic company in the world. So sometimes we ask ourselves this question, John's heard before, but if you dropped a nuclear bomb on the company, would it matter? Right. And so for most companies, you think, not really. I've got other choices out there. With TSMC, you don't. Actually, they are, in many cases, the only choice in the world. There are other people that make chips for various customers, Samsung most notably. But TSMC really has, the best ecosystem for making chips in the world. And they make... through the island of Taiwan, I should say, about 70% of the chips pass through the island, either on the front end or the back end. So John probably knows the actual number they make. I think it's around 50%, right, John?
Of what's that, of the chips globally?
Yeah.
Yeah, they've got 50% of the kind of like outsourced chip manufacturing market, and of the leading edge, where like you see NVIDIA or AMD or someone like that, it's much higher. It's like 80 or 90%.
Yeah, we should make this distinction between digital and analog. So when we're talking about TSMC, we're talking about digital chips that actually go into your computer or your cell phone or do some compute function. broadly speaking. But they're just very special. And because they're so good at what they do, they've actually developed this massive power law, meaning that it's been a winner takes most type market. And so that's a company that we've owned for a very long time. We continue to be happy owners of TSMC, and literally there's no replacement for TSMC.
Yeah, 50% broad market share across the world, and then much, much higher market share in those advanced digital chips.
Yeah.
John, what does NZS like about ASML?
Yeah, it's a good segue, because there's kind of two natural monopolies in semis, I would say, and one is TSMC and the other is ASML. So what ASML does is they make lithography equipment. So they would actually sell TSMC is their biggest customer. And so when you make a chip, you basically put the design in something called a photomask, which is it's like a stencil basically of the design. And then you shine light through this stencil and you project it onto the wafer. And that actually puts like the pattern of the chip onto the wafer. So that's an important part of the manufacturing process. And what's really important about what ASML does is really like this process of lithography is what defines the feature size of a chip. And so if you hear about like TSMC talking about 5 nanometer or Intel 7 nanometer, and this is kind of like the trajectory of Moore's law, those feature sizes are printed by ASML. And so they're the only company in the world that can do this. So it's like an amazing case study. They had one competitor, which was Nikon out of Japan. And coming into the last decade, Nikon basically said, this lithography market is getting so difficult, like the R&D burden and the complexity of what we're doing. It's like a physics, optics, material science problem. They threw their hands up and said, we're just not going to participate anymore. And so the amazing thing is a few years later, Intel, TSMC, and Samsung went to ASML and said, we're going to invest in you and buy almost a quarter of the company to like steer you along the path to basically make sure that we can keep going down the path of Moore's law, which is like such a cool story. And the amazing thing is back then, ASML was like a $25 billion market cap company that like no one has heard of. It was like a sleepy Dutch company, and now they're kind of a world beater. But so anyways, if you fast forward to today, given the investment from their customers, they developed EUV systems, extreme ultraviolet lithography, which are kind of the next generation of lithography systems. And this is actually where we basically like kind of passed what honestly we should be able to do in the physical world. But ASML, through 15 years of R&D, has been able to kind of re-energize their product set to get us down to kind of 7 nanometer and 5 nanometer, and honestly down to 3 and 2 and 2 or 1.5, and we'll keep going. So they're the only company in the world that can do this. It's just like kind of to Brinton's point on maybe a nuclear bomb being dropped on them is kind of morbid. Like if a virus like ate their whole IT system or something, like the world can't exist without ASML either. And so these EUV tools cost almost $200 million. That's going to $300 million over the next 5 years. And so we're kind of in, the second or third inning of kind of an amazing product cycle that's literally like one of the most important product cycles in the history of electronics if you look at what EUV will do over the next 10 years. And so a little bit of a long-winded answer, but we get excited talking about ASML. So anyway, I'll pause there.
I get excited about long-winded answers from you two at NZS Capital. Brinton, so John just said there's kind of two natural monopolies, Taiwan Semiconductor and ASML. In the Barron's Roundtable for this year, 2021, James Anderson, a portfolio manager at Bally Gifford, said, quote, China regards ASML and TSMC as the only two companies it can't replicate, end quote. Do you tend to agree with that statement, or do you think there are other semiconductor companies that China would have difficulty replicating?
Well, there are certainly other semiconductor companies that would have difficulty replicating, and for different reasons. I would like to hear John talk about Lam because he's so good on it. And Lam is a name that we did take from optionality through the middle to resilience last year and early in the year. So it's a good example of that. But Lam would be one of them. There's a few equipment makers they would have a very difficult time replicating. And then on the other side, I think what gets under-recognized is an analog company like Texas Instruments. Texas Instruments has about 100,000 parts. And so we live in an analog world, right? But computing is digital. And so we need to translate those analog signals into digital signals and then do the computing and then back to analog. And TI would have parts for everything from your Ring doorbell to the key fob in your pocket, to your garage door opener, to your clock, to your smart device, everything, right?
Your iPhone.
To your iPhone, yeah. They've got lots of parts in here. And they can actually sell you every part in here and design the board for you around whatever you're using for compute. the baseband or the application processor or the microcontroller and lots of devices.
Right.
So the reason China would have a really hard time replicating TI is not because the technology is so difficult, leading edge from like a digital perspective, although it's really difficult. It's just that it takes forever. So TI introduces about 500 new parts a year, and they have 100,000 parts in their base. So to recreate TI, it's gonna, even if you put a lot more horsepower to it, which would be hard to do, TI has a lot of horsepower, it would just take you decades, so it's a time thing as well. So I think a lot of the analog companies are honestly very underappreciated and how difficult they are to replicate.
Awesome. So Jon, I would like to hear what you like about Lam Research as well. What's your thesis?
Yeah, since Brinton teed it up. So I guess I would say like ASML, I genuinely think, and I know, I mean, honestly, if China wants to have their own domestic semiconductor industry, then they're probably working on re-engineering both lithography, which is what ASML does, but also etch and deposition, which are also two really critical steps of the chip manufacturing process that Lam Research comes up with. But honestly, I think it will take China 20 years to re-engineer what ASML does, and I think it will probably take them at least 10 to re-engineer what Lam does. And so what Lam does that's really unique is if you think about like flash memory chips, like in your phone, you've got 128 gigs of NAND flash memory that store your your music and podcasts and things like that. NAND flash actually hit kind of the wall of Moore's law before the rest of the industry in terms of planar shrinking, so two-dimensional shrink. So like chips kind of like just get smaller and smaller and smaller. It's like a house where the rooms are smaller over time. And so we hit the wall in the NAND flash market. And so we actually did is instead of like building a house with smaller rooms, we actually started building chips that look like skyscrapers. And so right now you're looking at like 96 to 128 like floors in this skyscraper of a chip. And to make those chips, you have to etch a perfectly uniform hole through from the top of the chip down to the bottom. And this is what Lam Research does that no one else in the industry can do. It's called high aspect ratio etch. And so the I think comparison of this is like if you had to drill a hole that was an inch around from the top of the Empire State Building down with like perfect uniformity. It can't sway. It can't like expand and contract. And they do that. I mean, a wafer, they'll have 1 trillion holes like that Lam will etch. And so they've done this. I mean, I think people underestimate how hard this stuff is to do just because they've built this in collaboration with their customers for 40 years, and so now they're kind of the 800-pound gorilla in the etch market. And so that's just really unique about the company. I mean, I think the other thing that we I think should talk about a little bit is just the overall backdrop in semiconductor capital equipment. It just has become such a high quality business. Like Lam is a really good example because 1/3 of the business is actually now kind of recurring revenue that's spare parts and services. And so, for a long time, this was like a boom bust industry. You'd have 2 years of growth, 1 year of like a 50% decline. And everyone's like, I hate these stocks. I never want to invest in them ever again because they're so cyclical. But now actually, if you look at the way the cycles have worked in semicap equipment, the average drawdown over the last 20 years from peak to trough was about 45%. And in the last one, it was about 15%. And so it honestly speaks to just the role that semis are playing in the world that like in the global financial crisis, like no one cared about chips. But now in the last recession we were in, which is a little bit unique, everyone needs chips all the time, and so you kind of can't stop investing in semis. And so the other thing, honestly, that's exciting near term about Lam is we're looking a lot more at obviously at onshoring U.S. manufacturing of chips. And so the idea of having multiple supply chains, the EU is talking about this also. And so like the semi industry is amazingly efficient right now, but it's going to become, I think, less efficient over time because you're going to have kind of specialized foundries or fabs in the US and in Europe for building chips like just for domestic consumption. And so that will actually all trickle down to the equipment guys.
Trillion holes in a way.
Efficient but fragile. Right, 1 trillion holes. Like is that like I can't even conceive of that.
It's crazy. So Brinton, I'm trying to get smarter in the semiconductor industry, but one company I don't know well that you own is Microchip. So what types of semiconductors does it make? What end markets does it sell into? And why do you like Microchip?
Sure. So, when we think about computing, most of us think about x86 Intel chips. right? So the chips that are in our computer, that are in servers, are everywhere else in the world. But when you want to do computing at a small scale on the edge, is what they call it, what you use is a microcontroller. And I think of microcontrollers as sort of like dark matter. Like you don't really know they're around, but they're everywhere. Literally, like I was saying before, in your key fob, in the doorbell, in your Nest thermostat, and your smoke detector, everything you can imagine, that all has a chip that does compute in it. And that's called a microcontroller. Microcontrollers are still very fragmented. Microchip is one of the largest microcontroller makers in the world, but there are others. TI makes them. Other companies make they're called MCUs as well. And on this, you're not dealing with the fast-moving digital side, maybe like sort of a company like NVIDIA, where you're really changing the world with your new design every year or two. You're dealing with hundreds of thousands of customers, everything from automakers to construction, to industrials, to everything else. And so this is also something that we think is a little bit misunderstood about semiconductors. People see them as technology, and certainly they are, but they're more like oxygen. So every other sector that's digitizing, and every other sector is currently digitizing, they're in the very early stages of it, has to use companies like Microchip that have this very long tail to computing. So they sell microcontrollers. The way you program a microcontroller is through software that also comes to you through the microcontroller vendor. And we think of these companies oftentimes as monetizing software and know-how and engineering through selling their silicon.
And I'll just add one or two quick things on Microchip, just because it's a name we've owned for a long time and have a lot of respect for. One is just like a really funny anecdote that the forever CEO, he was CEO for 30 years and just announced he's stepping down last quarter. Steve Sanghi, when Microchip was a young company, he would actually, in all the hotels he would stay in, he would actually take apart all the electronics and like look in the alarm clock or in the TV and see if they had that socket, see if it was like a microcontroller MCU or or a Microchip MCU, or if it was from TI or NXP or Renesas or someone. He would call his sales team and be like, "What's up with this like Sanyo, alarm clock here? Like call the company." And so I just think like culturally, that's just like an amazing example of what the company is like. And then the other thing I was going to say is Microchip went public in 1993, and last, I haven't looked at this in the last year, but last I checked, the stock has compounded at more than 20% since 1993. And it really, for what an amazing business and compounder it's been, I feel like it's not a household name at all. So we think that's a really, it's honestly really resilient business.
Yeah, and then on the management team, they just created a culture like that. Sanghi is a legend in semiconductor circle. He's been amazing from sort of every aspect you can imagine, but he's also cultivated a deep bench. So now the new CEO has sort of been at Sanghi's right hand for decades, Ganesh, and he's going to continue the tradition.
Fantastic. Another jump ball for either of you. Any thoughts on Intel? Does a prospective turnaround at Intel interest you at all? Apparently, Pat Gelsinger recently became CEO, and he mentored under Andy Grove and Robert Noyce and Gordon Moore during his 30-year career at Intel. So he's coming back to Intel. Does this story interest you, and what do you think Intel looks like in 5 years?
Oh man, I've got my popcorn out, John.
This is definitely controversial in semi-land. I guess, one point of context I think is actually really important with Intel. We've been very close to the company and watched kind of they've lost their lead in manufacturing, obviously, which is really an existential crisis for the company. But if you just take a step back and look at the company over the last 5 years and look at the P&L, so they've actually outgrown Apple on sales growth, gross profit growth, operating profit growth, free cash flow growth, you name it. Like, despite the fact that they've been like kind of losing their way this whole time, the business has actually been pretty resilient. I think it just speaks to, honestly, the quality of the franchise that they've built. And so I think things will get more difficult for them in the next few years. Like AMD obviously is breathing down their neck on x86, and the ARM value chain, both in or the ARM ecosystem in laptops and in the cloud, I think is gaining a lot of steam. But I think just like looking backwards a little bit at how resilient the financials have actually been in the face of this disruption is pretty important. And so What does it look like in 5 years? We're definitely intrigued. I mean, Pat is kind of a legendary, Intel leader. They've honestly tried to bring him back multiple times. Like this is the third CEO hire they've done in the last 10 years. And I think they wanted Pat for both of those hires, and they finally got him back. He's bringing a lot of talent back and a lot of energy back to the business. I think that's pretty palpable. And I think he's doing the right things. Like I think if you ask what Intel should do over the next few years, obviously he's a lot smarter than we are on the strategy of the company. But in the near and medium term, it's really kind of neutralize their manufacturing disadvantage by outsourcing as much as they can to TSMC. And they have a chiplet architecture where you can actually kind of manufacture certain parts of the chip at TSMC and other parts in Intel fabs and stitch them together with advanced packaging. That actually uses a lot of Lam Research equipment, which is great for everyone. So that's part of it is just kind of this chiplet strategy, and then continuing to invest. I think Intel's core is still being an IDM, like owning their own fabs and kind of having this hybrid model in the meantime while they try to claw their way back onto kind of the right Moore's Law trajectory is really important. And then the only thing I would say is like what the business should look like in 5 to 10 years is there's been a lot of arguments that Intel should become more like a TSMC, like an outsourced third-party manufacturer. And I just think that really understates how difficult that business is to kind of start from scratch. TSMC is like amazingly customer centric. They have a huge ecosystem. Intel has tried to get in this business a few times and really honestly failed over the last decade. And so I would like to see Intel to stick to their knitting and maybe layer on more. I think they're going to invest a lot more in ARM and kind of like, embrace disruption a little bit. But so we'll see. I think we're a little bit contrarian on what they can do in terms of maybe a little bit more positive on the future of the company. But it's a very heavy lift to get back on the right cadence of Moore's Law, and so that's going to be a big challenge for Pat. But he's probably the right guy for the job.
He probably is, and like you said, they do have those strong financials. So better to have strong financials than not if you're going through a turnaround, I suppose. Brinton, Amphenol. They sell sensors. What kind of sensors do they sell? What end markets does Amphenol sell into, and what's your thesis there?
Yeah, Amphenol is another sort of dark matter company. You have 20 products in your house made by Amphenol right now, and you just have no idea, nor would you ever need to. But they sell connectors and sensors. So that's a big TAM. It's actually bigger than $100 billion TAM. And a connector is sort of it connects the guts of a device. So think about your iPhone, not like the jack on the bottom, but like the stuff inside that's connecting the semiconductors up on the printed circuit board. And then it can go all the way to the connectors in electronic cars, or the connectors in your smart speaker in your house, or anything. It's the guts of everything. And then in terms of the sensor and the connector are always together. So this could be something as simple as like that air pressure sensor that's in most modern car tires. It'll tell you when your tire is low. That's a sensor inside of your tire that a company like Amphenol would sell, or the sensor on your transmission to tell you something is going wrong there, or lots of things. Again, we live in an analog world, so we have to take that, we have to sense that. The temperature outside, or the air pressure, or whatever. We have to compute with that and then put it back into software on the display to give you information. So Amphenol is this amazing company. They're number 2 in that big $100 billion TAM. They operate as a set of distributed little companies. TI does this too. But Amphenol, it acts like a big company, but it's really 100 small companies inside of that. And they're run by this very flat management team that is in this kind of dodgy office building in Wallingford, Connecticut. So I just love that. Like the CEO will actually go out and buy paint their own office building. They have this sort of like, I think of it as, I don't know if you guys remember Capital Cities from Thorndike. Tom and Dan that ran Capital Cities, eventually they bought ABC and sold Disney. And that's how also Eisner got his went to Disney and got his job there as CEO. But they're like that. They're like very value conscious. They are extremely empowering to the group, but the group all operates under sort of an Amphenol set of principles, and they're demanding. If you can't produce those over time, then that's a problem.
Awesome. Probably have time for one more stock. John, what's your thesis on Cadence Design Systems?
Yeah, this is a good one to end with. This is one of our kind of like favorite all-timers. So Cadence, going back to the kind of the ecosystem in the semi industry, Cadence provides the design software for semiconductors. So if you're like an engineer working at, honestly, whether you're at Apple, which is a systems company that makes their own chips, or at NVIDIA or TI or something like that, you like go in every day and you design the chip. It's like the Excel equivalent for a financial analyst. Basically, it's like you live in this software every day. And so it's a two-player market. It's Cadence and Synopsys. So it's a really high quality duopoly. Like pricing is very stable. And so, that business is interesting because it kind of grows with R&D investment in the semiconductor industry. And, 10 years ago, it was like you only had kind of the chip guys to sell to, but now you've got, Apple is obviously so prominent now for what the innovation they've done in semis, but also Amazon is becoming a huge player in semis, and Andy Jassy, I think, as CEO, will just continue to push that. Google, same thing. And then you actually have a lot of startups. There's unicorns in semis now that have raised, hundreds of millions in VC money. And so they're kind of like riding this wave of the renaissance in the overall industry. And then what's unique about Cadence is two things. So one is they're actually gaining share in the market. They're actually getting share in digital design from Synopsys, which is kind of like this Herculean effort. This is like one of those markets where you never really thought that share would shift. And then the management team is honestly just amazing and has innovated extremely quickly to roll out new products to take share. And then they're also going from kind of like core chip design to more like system design. They call it system design enablement, where instead of just like designing the chip for the car, what if you can lay out like the whole electronic system and the whole printed circuit board and see how that's going to interact like with like both on the printed circuit board, but within like all the other signals in the car. There's like 4 or 5 different networking signals that have to, be sent around a car. And so they can actually help you model all of that. And they can do that in aerospace and defense. And so they're kind of like moving into new verticals. And then they're actually also trying to push into more like simulation type markets, like what you would see ANSYS doing with like computational fluid dynamics, electromagnetics, things like that. And so they've actually just taken what was a little bit of a sleepy business doing the chip design software. That was like a 6% growth business, and taken their growth to double digits over the last 5 years, which is really impressive. And I just think the management team there, so Lip Bhutan is the CEO that joined in the financial crisis when the stock was like $2 a share. And honestly, the company was really in shambles, and he's like totally re-engineered the culture, the product portfolio. And I think it really should go down as kind of one of the best turnarounds in tech over the last 15 years. If you put like Microsoft at the top, and then you probably have like AMD and like Lisa Su, what she's done there, and then honestly Jensen at NVIDIA. I think Lip-Bu kind of belongs in that second tier at Cadence for what he's accomplished. It's incredible.
Wow. I can't thank y'all enough for coming. This was honest. So I need to have you back, first of all, because I wanted to talk about some of your software picks as well. But this was honestly like a university level, like 4-year degree in semiconductors in an hour. Like, I just learned so much, and I know our members did too. So I'm really grateful that you joined us. I can't thank you enough.
Yeah, thanks for having us, John. It was really fun.
Yeah, thanks for having us, and sorry for being so long-winded. We're just passionate about this stuff, so we can't get away from ourselves.
You can see why I won't even come on these shows without John anymore. He's just so amazing.
He really is. Y'all did a real treat for our members. So thank you so much.
Thank you.
Thank you, John.
Yep. Bye-bye.
Right. Have a good one.